Welcome back to another episode of Almost Wealthy. Today, I hit a milestone. I want to say thank you to the people that have subscribed and viewed my content. I know that this might be a small number in YouTube terms. It means a lot because 500 people who found my channel watched at least one video of me putting myself out there about my portfolio journey and trying to build something real. And you decided to stick around. It means a lot, and I want to thank you. So let's get into the topic. So on my last video, this comment came in, and I'm going to read it. First off, shout out to Rusty Tabby 793 for the comment. I love when people write comments because I like to have the conversation, and it's worth having. The comment read, "You are going to have to change your name to Almost Broke," which I found hilarious. I have to stop watching you kill your brokerage account, and in 6 months, you have changed your strategies, thesis, and holding more times than I can count. Paying bills using dividends is not investing. Using margin to pay bills is not investing. It's driving me nuts. I wish you well. I love the comment. And here's what I replied. I'm not spending my investment money on bills. I'm borrowing cheap to pay the bills so my capital stays invested in compounding. That one sentence, that's what this whole entire video is about. And I'm going to break it down for you. And I get it. On the surface, margin sounds reckless. But stay with me, because when you actually run the math, the reckless move is the other one. So when people think about margin, or when they hear margin, they think about a person's leverage betting on borrowed money. They get a margin call probably at 2 o'clock in the morning, and he pretty much loses everything. And I want to be clear, that's not what I'm doing. I'm borrowing against assets I already own. My portfolio on M1 Finance to cover the living expenses, just using collateral to generate liquidity without triggering a sell. The brokerage calls it a margin loan. I call it a paycheck that doesn't cost me my shares. But the real argument is capital efficiency. But here's the actual logic, because I want to be specific about why this works. My portfolio generates income, dividends from SPYI, PYMI, GPIQ, and SCHD. Income hits every month. Instead of redirecting that capital to bills, or worse, selling shares to cover them, I borrow against the portfolio at a low to value ratio. Right now, I'm targeting 12%. I'm not even nowhere near that 12%. I'm at probably 1.5 because I'm only paying one bill until I get to my phase 2. The borrowed amount gets repaid by the income the portfolio generates. Meanwhile, the principal, every share I own, stays fully invested in compounding. The net result, my bills get paid and my money keeps growing, both at the same time. But is that reckless? To me, I don't think that's reckless. I'm just deploying capital effectively. The wealthy have been doing this for decades. We just don't see it because the conversation about how rich people actually manage the liquidity doesn't make it to the mainstream. But with the internet, we are starting to hear more about it. So the problem is not reckless. The problem is the hidden cost of selling. So why is selling the worst option? I have 3 costs of why. And the reasons nobody sees this clearly is because they're invincible until you start looking for it. Cost 1 is capital gains tax. The moment you sell your appreciated shares, you owe the government long-term rates at 15 to 20%, depending on your income. And that money is gone and you can't reinvest it. Cost 2, you kill the compounding mechanism in your portfolio. Every share you sell stops growing permanently unless you buy back in at whatever price the market is at that time. Cost 3, you lose dividend income. Sell $1,000 of SPYI and you cut off the monthly cash flow those shares were generating. Real income gone. Selling isn't free. It looks free because the cost doesn't show up as a line item, but trust me, it's there. All right, let's run the numbers. My margin rate at M1 Finance is 5.65% annually. Say I need $3,000 for expenses. Option 1 is I sell my shares, I pay capital gains tax on appreciation 15 to 20% long term. That's around $450 gone immediately. Plus, I lose whatever dividends those shares would have generated going forward. Option 2, I borrow $3,000 at a 5.6% annual rate, and annual interest for that is about $170. The shares is still there, still growing, still paying me income that works to repay that loan down. So $170 a year to keep $3,000 of compounding versus $450 gone on day one and lost growth forever. The interest is the cost of not selling, and that's what my plan is all about. Now, here's where I have to be honest, because there is a way to blow this up. Margin becomes dangerous when you borrow too much relative to the portfolio value. The ratio to loan to value, also known as the LTV, if my portfolio is worth $100,000 and I borrow $12,000, my LTV is 12%. My M1 allows up to 50% LTV. I'm targeting 12%. That gap, 12 to 50, is what stands between me and a forced liquidity in a bad market. If the market drops 40%, a portfolio 12% LTV doesn't come close to a margin call. A portfolio at 40%, one bad month, and a broker is liquidating your position at the worst possible moment, locking in losses you didn't choose to take. The people who blow up on margin aren't using the wrong strategy. They're just borrowing too much money. Now, all right, let's bring this full circle. My portfolio generates income. The income covers the interest of the loan, so the borrowing is serviced by the portfolio itself. Any surplus above that goes towards repaying the principal, which lowers my LTV further. As the portfolio grows, the principal remains invested, compounding and generating income. Simultaneously, the collateral increases, enhances borrowing capabilities. However, the LTV remains low because the denominator continues to expand. Right now, my portfolio is at $6,700. The income doesn't fully service the loan. I'm making up the difference because I keep depositing new money. I'm building the mechanics now, so when the numbers hit the scale, everything is already running. So what's the end game? My first goal is to generate $1 million portfolio. At that size, I borrow $40,000 a year, living expenses at a roughly 4% LTV. The income portfolio generates covers the interest, the principal never gets touched. Asset compounds, income grows, and you never sell. And when I die, those assets will be passed to my heirs with a stepped up cost basis. The capital gains that would have been owed is wiped out. That's not a loophole. That's how the tax code is written. The wealthy have figured this out a long time ago, and I'm documenting what it looks like to build towards it. But let's be honest, let's have some risk involved, because I'm not going to close without talking about this part. There's always risk. 1, margin call. The market drop means your broker can force you to liquidate without warning. 12% is my ceiling, especially to prevent this. Not saying it won't change later on as I keep building up, but the whole plan is to be conservative right now while I build my nest egg. Risk 2, rates change. M1's current rate is 5.6%. If that goes to 8 or 9, the math can shift. Run the numbers at high rates before you can borrow. Risk 3, the income gap is real at this portfolio size. I'm not living off margin yet. I'm repaying with my new deposits. Know where you actually are, not just where the strategy ends up. Now let's go back to a comment in the beginning of the video. Paying bills using dividends is not investing. Using margin to pay the bills is not investing. I flip that. Keeping your capital fully invested in compounding while using cheap borrowing to cover your expenses, that's the whole point of building a portfolio. Dividends aren't being spent. They're paying down the loan. The shares aren't being touched. I'm building this publicly with real numbers every week. Subscribe if you want to watch how this plays out. Drop questions in the comments, especially if you think I'm wrong. I read them all. See you on the next one.